that CPI number certainly inspired quite the reaction. Market's absolutely screaming today. Welcome to Macro Money. This is Ilya Spivak, head of global markets and macro. Let's try that again, head of global macro. Wow, that's how emphatic of a day it's been. I don't even know my own job title. Welcome, everybody. We're going to unpack this a little bit and just see what is going on here in the aftermath of these numbers. And really, the goal will be to figure out what the reaction function is, because we have another important piece of economic data that's coming up here, looking at retail sales numbers for October. That, of course, a major input into the Fed's calculus. And as ever, it's the Fed's calculus that we care about as we look at these economic numbers. So let's first have a look at what CPI did, why it did it, what it is about these numbers that the markets are looking to see, and what it is about them that makes them do what they do at this point. And from there, look at the retail sales report, look at what's expected, look at what's likely to occur, and then try to benchmark what the markets are going to do with that information. So, not surprisingly here, the first step will be to have a look at what it is that the markets were so inspired by when a seemingly muted, if a little bit better CPI number crossed the wires. So here's the response. S&P up 2%. And these are not the latest numbers. This is about an hour before the close, but you certainly get the flavor for what's going on here. So S&P up 2%, crude oil nowhere, gold up almost 1%. The real big movers, though, showing up in rates, 10-year rate and 2-year rate down almost 4.25% here. NASDAQ up 2.3%, and the dollar sharply lower. We're using the euro here as a stand-in. It's up 1.7%. At one point, it was closer up to 1.9. So really a very, very emphatic day for markets. I suppose we can summarize it as stocks up, yields down, dollar down. There's probably still a bit of mud there in oil and gold from the conflict in the Middle East. We've been looking at risk of geopolitical uncertainty filtering out of these markets. And so it does seem like that maybe has made for a little bit more of a muted response here. Crude oil steady, gold probably not as much of a gain here as it could have been the case were we not seeing the worries around the Israel-Hamas war spreading to other combatants exiting the market. It seems like that concern is increasingly fading for investors. They're looking at this being a bilateral kind of thing that doesn't necessarily disrupt oil shipments from the region, doesn't necessarily suck in any of the key belligerents that overlap with other conflicts, notably, of course, in Ukraine, say Russia as a supporter of Iran, as a supporter of Hamas, or let's say Saudi, or even Turkey, or even the US. So all of those very kind of distant possibilities getting downgraded even more so to highly unlikely settings, and that seemingly keeping gold from going higher than it did, and undermining crude oil's ability to capitalize on the generally risk-on bias. It probably doesn't help, of course, that crude oil is relatively cyclical, and so it benefits when the risk-on mood is because growth is better, demand is likely to be better with it, and this was not the kind of CPI number that spoke to greater demand. Markets are not rallying here because growth is going to be good, as it were. As a matter of fact, they're rallying because conditions in the CPI report pointed to softness. And that softness is likely to bring Fed rate cuts closer. It is the cheaper cost of capital, it would seem, that the markets are cheering for. Here's the CPI outcome. We can see here, service sector still the main component of lingering inflation. No surprise there. The decline in crude oil prices giving us a little bit more of a negative pull on inflation here from the energy component. Once again, it had been eroding over the preceding 3 months, becoming less negative. It is now becoming more negative again. That likely explains how the headline has come down and shows us a little bit of a lower headline, 3.2, than expected, 3.3. But the really big story, seemingly, the decline in the core part of inflation. Expectations were for it to hold steady, unchanged at 4.1%. Instead, it came down to 4%. And very encouragingly, the biggest part of the decline is also happening in the biggest part of the pie that's holding up services inflation, and that is housing services. Now, this is very, very good news as far as the Fed is concerned, because it couldn't really do very much here. There's not a whole lot that the Fed can do to unstick housing inflation, because in large part it is there because of its own actions. So when the Fed went on a massive rate hike campaign, not surprisingly, it increased all interest rates in the economy, and mortgage rates went up with that. And so now the average mortgage rate is closer to 8%, but the average rate on existing outstanding mortgage debt is 3.6%. And so as the markets look at this and say, well, if I sell my house, the next one I buy, I have to finance 4% more expensive. I'm not doing that. I'm going to do everything I can to avoid doing that. And so housing inventory has collapsed. And because of that, of course, the price can't really go down. If there are no sellers, how is it ever meant to? So what we're looking at here is quite welcome from the Fed's perspective, because it suggests that the secondary effects of its squeeze on the economy are finally doing its thing. The housing component of inflation really comes from survey-based data, because, of course, house values don't really move with inflation to that kind of an extent, again, because mortgage rates get locked in for 30 years, and they're clearly, especially at this juncture, a very critical consideration for why the price of housing is doing this or that. So as we look at this, that housing component becomes really critical, because the way that it's calculated is government statisticians essentially conduct surveys, and they ask owners of houses, well, how much do you think you could rent your house for? Or how much do you think it would cost you to rent an equivalent space to what you own? And based on that survey data, they impute what it will be for the contribution of housing into CPI month to month, because this is not the kind of thing that moves with that kind of frequency typically. And so you need to take this kind of survey approach, as opposed to saying eggs cost X last month versus Y this month. Take the difference. There's your inflation gauge, to put it simple. And so what you end up with then is survey data whereby owners of houses are saying to data collectors that they would now expect to charge less than they did before were they to rent their space, or would expect to pay more were they to rent an equivalent space. And so that tells you that consumer sentiment is starting to pick up on deteriorating economic conditions and disinflation, which is, from the Fed's perspective, excellent news. In the wake of this CPI data, we can see that expectations for Fed policy shifted downward. So the solid line there is the current setting for the implied Fed rates path over the next 3 years. The small dots line there is where it was a week ago, and the big dots line there is where it was not too long ago now, just 2 weeks ago, when the Fed last met to announce policy on November 1st. And we can see that the curve has pointedly shifted to a flatter setting. So the solid line is below the other two. So the markets now expect a more emphatic cutting cycle. And that's the response we see in markets today. Lower yields, higher stocks, weaker dollar. And we can see this relationship in spades here as we look at really what's been happening since mid-year in the wake of the SVB-led banking crisis and that version of the debt ceiling debate. Markets had baked in significant rate cuts as soon as possible, essentially, expecting that between December of this year and December of next year, we'd have something on the order of 1.75% in cuts. You can see that bit of it right here. As those risks receded, the banking crisis looked contained. We got the debt ceiling shelved for a while. Those cut expectations were reduced, and therefore the expectations for a higher cost of capital arrived and started to move stocks lower. So you can see fewer rate cuts here. So from 1.75% down to more like 1, we saw that stocks didn't like it and they declined. We can even see that incrementally here. So when this goes up, this comes down. When this starts to come back out, stocks rebound. When this starts coming in again, they fall again. When this starts to come back out, they bounce, so on and so forth. We can see most recently, as it starts to look like the markets have turned a corner and rate cut expectations start to build again, stocks surge. We saw that in spades, of course, today. So we get a big jump in rate cut expectations and stocks power higher. It's a very similar story looking at the dollar. As we get fewer cuts, the dollar's yield advantage is bolstered. It goes up. As we turn a corner here and more cuts start to enter and the amount of cuts starts to grow again in expectations, the dollar tops and starts to head lower. We can see that, of course, with very clear relief here as we look at what was happening in markets today. Now, if we look at expectations currently, we can see no further hikes are priced in. Probability is 0 change in policy in December and in January. There's a narrow 29% chance for a cut in March. So the markets are open to the possibility, but they don't think it's going to happen here, less than even odds. Those odds surge to 82% come May. So at this point, the market is expecting that a cut in May is very likely. That's a month sooner than what we looked at yesterday. Yesterday, before this CPI data, May was off the table for the most part. There was a significant 70+% chance for June. And by July, we got the first cut, 3 cuts in total were baked in for next year. How things change in less than 24 hours. Here we are now looking at May, looking like a very likely meeting to see the first cut. That cut fully priced in by June with a further 48% chance of still more easing. Second cut fully baked in by July. Third one looking very likely come September, 81%, and fully baked in by November, with a fourth one looking very likely by then, and then the fourth one in by December. So on net, we've grown by 125 basis point or 0.25% cut in the outlook for next year between yesterday and today. So the markets, again, looking at this shift in the curve here, we can see about a 25 basis point shift in the end point for the curve. That's one extra cut. We can see that in spades here. So it was 3 for December or by December yesterday, and it's 4 now. 4 at 25 basis points or 0.25% a clip. That's 1% in rate cuts next year. So that's how the stage is set. This is what the markets are doing, and this is how they are interpreting economic data. They are saying anything that feels like it's bringing more rate cuts to the table sooner is good news. That's what we want to see. That's what drives stocks higher. That's what hurts the dollar at this juncture. So that's our reaction function. That's what the price action is telling us. With that, we turn to what is the next catalyst, and that is October's retail sales report. And here we're expecting, after a 0.7% rise in September, a 0.3% decline. So we're looking for retail sales to fall. This will be the first decline since March, if it comes out as expected, or indeed if there's a negative sign in front of whatever comes out. This, of course, would comport with what the markets want to be seeing, because from their perspective, the weaker the consumer, the weaker the consumption. No big logical leap there. But of course, household consumption is 3/4, give or take, of U.S. economic growth. So to see weakness here is to tell the Fed loudly that more cuts need to come sooner rather than later. And that, of course, as we've just learned, is exactly what the markets want to scream at the central bank. So how likely is this, and why is this where the market is even looking? Why the decline? Well, if we look at the way consumer confidence has evolved in recent weeks and months, we can see here we saw rollover already in consumer sentiment. As a matter of fact, if we look at the timing for the process here, we can see that we already were looking at a topping in consumer confidence, essentially, since mid-year or so. And the latest numbers here for November's surveys are the weakest on the overall index since May. So clearly consumers are starting to feel the pain. Now, we can see that in even sharper relief in terms of their behavior vis-a-vis credit card spending and overall borrowing. Now, of course, this is exactly what the Fed wants to see. They want to see higher interest rates slowing economic activity. And, not surprisingly, that's exactly what appears on display here. So the dark line is credit card delinquencies of 30 or more days. The red line is 90 or more days. And the gray bars there are overall loan delinquencies on all consumer loans across all U.S. banks. Now, the gray bars are quarterly data, so not surprisingly, they're a little bit lagged. And the latest numbers that we see there actually are from the second quarter. So we still have a little bit of a lag there. But if we look at the close relationship between the pickup in overall loan delinquencies and what's going on in credit cards, which is a timelier data set running through September, we can see that at this stage, September has the highest 30-day credit card delinquencies since all the way back to June of 2020. Now, June of 2020, not surprisingly, that's a familiar timeline to be sure. That's basically 6 months into the COVID lockdown. So we're looking at a very significant signal here, seemingly, that consumers are feeling the pain because they are not paying down their credit card loans shorter term with the same delinquency rates as prevailed at the heart of the lockdowns. So this is not looking good, to say the least. And of course, because this credit card data seems to lead significantly the overall loan delinquencies direction, one would expect that since for the past 3 months, these things have been going higher and about through the same period as sentiment has deteriorated. So this part of it right here largely lines up with this right here. And so what we're looking at then is a consumer that's plainly turning more defensive. It is also perhaps emblematic of consumers trying to run up spending on credit, despite the fact that rates are as high as they are, and facing increasing difficulty with actually coming up with the cash to cover that. So it's telling us that the prospects for consumption are ebbing. Why is that? Well, the employment situation is certainly a part of it. In the very last set of ISM surveys, this is from the Institute of Supply Management, we can see that service sector employment, which is by far the largest employer in the U.S. economy and most developed economies, has basically stopped and is at standstill. So this is working in the same logic as PMI surveys, where 50 is neutral, above 50 is growth, below 50 is contraction, and the further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So what you see here with the orange line here, that's the service sector, is that it's basically landed right on top of 50. So effectively, it's, if you squint really hard, just a hair above it. So we're looking at essentially standstill in service sector hiring at this point. Meanwhile, hiring in the manufacturing sector oaked up to positive territory a little bit in the September period, and then come October, once again firmly under 50 and so shrinking. So the manufacturing sector is actually shedding jobs at this point. Well, that's not exactly a recipe for consumers spending. Jobless claims telling us a similar story. Weekly claims we can see here rounding out a bottom on initial claims, and at this point, claims above their 4-week and their 12-week average. That's not a good sign, but it doesn't look nearly as dire as what's going on in continuing claims. And the reason why continuing claims are such an important indicator here is it suggests that not only are people applying for benefits because they're losing jobs, but they're applying to extend those benefits much more frequently and in much larger number because they're having a hard time finding the next thing. And that's much more emblematic of weakness in the labor market. So what we're seeing here is that not only are jobless claims significantly higher, we're at this point looking at jobless claims, in particular, continuing claims, at the highest levels that we have seen them since April, but also that we're well above averages, 4-week and 12-week. So that's a 1 month average and 1 quarter average, give or take. And that we are increasingly seeing consumers hampered for income. And that's the kind of thing, of course, that's driving consumption or undermining it in this particular case. And of course, there is the big kahuna of jobs reports and jobs numbers. The latest from the employment situation report for October, weak job creation, 150K. That surely hasn't missed anybody's attention. But much more importantly, the unemployment rate up to 3.9%. That's the highest that we have seen it since January of 2022. So almost 2 years now. And needless to say, this is not the rosiest environment for consumers and for that which powers U.S. growth. So all of this put together, and you can see why the markets are starting to look for retail sales to roll over. Now, part of this, as we saw in the CPI data today, energy became a little bit more of a drag. Part of this is probably weaker contribution from automotive spending and gasoline. But what we're really going to be focusing on here is not those parts of it. And essentially all the market needs to see is data that suggests that indeed all of this weakness in the labor market and the turn in sentiment is translating into reduced spending, not just because certain commodities have become cheaper and so aggregate numbers start to look smaller, but because there's a genuine deterioration in the propensity to consume, not just a price effect. And as long as that's the case, and indeed as long as the numbers don't meaningfully scream out, wait a minute, the Fed has to hold higher for longer, well, the markets get a green light to do more of what they did today. And so we probably end up with higher stocks, a weaker dollar, and lower yields. And of course, by extension, higher U.S. Treasury bonds. As long as whatever number comes out does not upset the sooner arrival of interest rate cuts. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, where we go over the day's events on Wall Street and try to figure out what comes next. I'm back on with Chris for Futures Power Hour on Friday, on with Tom and Tony for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money is going to be back tomorrow. See you then.